Hey everybody, it's Thursday. That means it's time for your Thursday thought. My thought for you this Thursday kind of is dealing with interest rates and inflation. Of course, really since the Great Recession, interest rates have been low, hitting historical lows in the mid twos. I'm talking about mortgage interest rates here in the mid twos and upper twos. I think now we're somewhere in the mid threes for most buyers right now. And so it's a really great interest rate. It's part of the reason that we've seen price increases go up over the last couple of years, that and a lack of inventory. So people can afford more house when their interest rate is lower. And so you would kind of have interest rates on one side. Now, in the past, historically speaking, we're always kind of told that inflation has been around 2%, and it's kind of always kind of hovered around there and has continued to kind of climb. But in the last year and a half, we've kind of put so much money into the system through some of the economic relief packages due to the pandemic. We've seen some inflation increase, right? So I think the last thing I heard was we're north of 6% over the last 12 months as far as the inflation. So it's really kind of, and of course, what is inflation? Inflation is just your dollars not going as far, you not being able to buy as much. The purchasing power of your dollar has gone down. And so what has kind of made me think about this was a conversation I had with some people recently, and that is that you're borrowing money at 3% or 3.5%, yet the money's losing its value at 5% or 6%. And so for most of us, your house payment or your rent payment is a significant portion of your household income. And so if you can lock that price in while interest rates are low, then at least that portion of your budget gets to remain the same, and while the rest of your money continues to lose its value as inflation continues to be undercutting the value of your dollar. Now, why that's important is because you've probably heard is that the Fed has said that they're going to be increasing interest rates over 2022, and while your mortgage interest rates aren't directly tied to the Fed rate, they're tied to the 10-year Treasury bond. Eventually it will catch up. When the Feds raise their rates, the 10-year Treasury bond will fluctuate, and it will eventually affect your mortgage rates. And so buying a real asset, real estate, at a 3% or 3.5% or even 4%, while inflation continues to be 2%, 3%, 4%, 5%, you're going to be locking that, at least that one aspect of your financial life, into a 30-year fixed rate mortgage, which could obviously really greatly benefit you, because if dollars keep coming into the system and dollars keep losing their value, obviously your house is going to be worth more and more of those dollars, and so the ideal being that fixed asset is going to be worth more dollars as inflation continues. So that's my thought for you. So if buying a home is part of your 2020 plan, do so sooner rather than later while the interest rates are still low. If I can be of assistance in that process, of course I would love to be. Shoot me a message, give me a call, shoot me an email, and I'd love to help. Hope all that made sense. Thanks for tuning in to this week's Thursday Thought, and we'll see you next week on next week's Thursday Thought. See ya. Bye.